Hello, this is Briant Sikorski. I'm an independent financial planner and wealth advisor with Stratos Wealth Partners. Today, we're going to look at LPL Research's 2022 Mid-Year Outlook, Navigating Turbulence. I don't like turbulence, so I don't know if I'm going to like this report, but we'll see. If we think about it, the markets themselves really rarely give us a clear indication of what's really going on, and not always giving us a clear skies. But I hope that today, with this presentation, I can kind of uncover some of the backdrops of what's going on with the market and how you could possibly utilize this to your own benefit with your own investments. So this has been a pretty bumpy year, I would agree, but at least so far, it's getting close, but not so far, have we had the impact as great as it was back in 2008 to 2009 or even 2020. But it's still been, without a doubt, a rocky road that has tested all of our stomach lining, I guess. So let's take a look at what we've got here as far as the economy goes. Now, it's very interesting to read that the statement here is economic growth will likely downshift in the latter half of 2022, reflecting a slowdown in real spending as a consequence of elevated persistent inflationary pressures. So this is interesting that it says that recession risks are increasing, but our base case is no recession this year, as consumers, particularly the upper income ones, can sustain spending patterns from income growth, excess savings, and revolving consumer credit. I did read some of the backdrop to this, and it was kind of interesting to learn that consumers actually measurably reduce their debt over the last few years, being quarantined or locked down in their own homes. They couldn't go out to eat, they couldn't go on a vacation, they couldn't buy new things that could be used, so they saved money instead. And as a result, we've seen a downturn in the overall debt balances of consumers. So LPL Research's department believes that the domestic economy will continue to grow this year. That's really key. With all the stuff that's been thrown at the economy, it's still continuing to grow. We've only had an anomaly of a negative first quarter GDP, and their expectations the economy has sufficient momentum to offset the inflationary pressures. And therefore, best base case is for a recession, either not at all, or if anything, minor in the first quarter of next year. And the hope is that we could resolve some of the issues I'm going to cover in the next few slides. It may not be evident at all. There may not be a recession whatsoever. So while overall consumer spending will likely slow during the latter half of this year as inflation pressures weigh on consumers and wage growth likely to lag inflation, these factors in tandem will erode consumers' real purchasing power. However, recent spending activity shows a fairly stable consumer, with real consumer spending rising 0.7% in April alone, and the fourth consecutive monthly increase in real spending before pulling back a bit in May. The job market is still tight, supporting consumer spending from gains in personal income, but the real cushion for consumers comes from roughly $3 trillion, here I was mentioning, in excess savings accumulated during the pandemic. So we've heard about supply bottlenecks, which means anywhere from trucks to shipping, to ships, to airplanes, to whatever, where we've got these various, airports, ports, trucking locations bottled up, unable to deliver goods. But the perspective here is that this supply bottleneck is going to improve, and we're expecting to see firms restocking their inventories, supporting underlying economic growth. And here's what I think everybody is waiting for, is the big I word here, inflation. And the perspective here is that inflation rates are expected to cool throughout this year, but the cool down period will be long and slow, and inflation will still very likely be above the Fed's long run target of 2%. Improvements in supply chain have started to impact consumer prices. Technically, consumer price changes lagged by 4 months, are 72% correlated with the New York Fed's global supply chain. So we are expected to see, a slowing, however slow, of the inflation factor and its impact on the stock market. So stocks are expected to face a number of headwinds in the second half of this year, but the amount of this turbulence will likely depend on the pace at which inflation falls. So it's tough not to see the bull case through the cloud cover right now, and volatility may persist, but an improved macroeconomic environment may set the stage for higher valuations, for further earnings growth, and solid gains for stocks over the rest of the year. And that surprised me a little bit. I was not of the opinion that our expectation that we would have my research department would have such a bullish outlook on the stock market for the remainder of this year. So the amount of time it takes for stocks to return to their prior highs will likely be largely determined by the path of inflation. And my research department expects perhaps 1.5 percentage points to come off of core consumer prices by year end. And the latest reading for the Fed's preferred inflation measure, the core personal consumption expenditures, or PCE index, which excludes the inflation inherent in food and energy. The first quarter earnings season wasn't pretty, but given the difficult environment, a roughly 10% increase in the Standard & Poor's 500 earnings per share and nearly 14% increase in revenue, both solidly above expectations, were excellent results. Companies were generally able to pass along price increases to limit pressure on their profit margins amid higher material and transportation costs, labor shortages, and rising wages, not to mention various supply chain disruptions. Now, with so much uncertainty, this is a difficult stock market to forecast, and the range of potential outcomes is wider than most years. The challenge comes from predicting how fast inflation will come down, which will determine how much profit margins narrow, how fast earnings can grow, and where interest rates eventually land. Now, the opportunity for a strong second half is not hard to see. Earnings growth and higher valuations can be a powerful combination. Our best case expectation calls for a price earnings ratio between 18 and 19 and $235 in Standard & Poor's earnings per share in 2023. Now, historically, individuals purchase bonds for their liquidity that they offer, the diversification that they provide, and acting typically as a hedge against downturn in the stock market. Now, that hasn't really been the case for the last couple of months, if not last couple to few years, in which the stock market was very high and the bond market was very low, with yields sometimes approaching zero, if not negative. So, where do people go if the bond market is not providing any yield? They'll go to the stock market, and we'll see a little bit more about this in just a moment. So I don't know if you ever heard the phrase TINA. It's pretty funny. I love these acronyms. But TINA stands for there is no alternative. And this has been a big reason that diversified asset allocation portfolios have been overly geared towards stocks or equities over the past few years. The attractiveness of equities over fixed income was undeniable, with interest rates hovering around all-time lows, including zero and negative numbers. Now that interest rates have moved higher recently, though, that relative attractiveness between stocks and bonds is a bit more balanced. So therefore, with investors for investors unwilling or uninterested in taking on the equity risks, there's a number of fixed income markets with yields trading above long-term averages. So not only can we see investors transitioning out of the stock market to some extent into the bond market, but we can also see where that could lead to a reduction in the overall price or the overall index of stock markets. So since 2000, the correlation between stocks and bonds has been, here they say negative, which means they're in opposition to each other. That is, as equity prices were falling, bond prices were rising. Although there's been considerable variation with that relationship, it's been, and at times the relationship between stocks and bonds have in fact been positive, but we're getting back to a bit of what some people would call normalcy, where we do have a trade-off between stocks and bonds. And some would say that's a healthy thing, because you don't want to have investors. I mean, if you've got, let's say, retirees who are in the bond market earning 1%, their financial retirement plan was maybe put together with the expectation that they could get 4 or 5 or even 6% of their money. What are they going to do? Well, they go to the stock market where they can get 4, 5, or 6%. But in the stock market's typical downturns of, about every 10 years, we have something like a recession of sorts. We've seen individuals like retirees per se, losing 15 to 20% of their principal on their portfolio because they pulled everything out of bonds and put it into stocks. So you can see so far that inflation has been, the top of mind commentary as it relates to what is the economy and what are the markets going to do moving forward. A close second place to that is the midterm elections. And these elections are often a balancing act for voters, historically tilting heavily against the sitting president's party. So since 1900, the president's party has lost House seats in midterms 87% of the time, averaging 30 seats lost. In the Senate, where only about 1/3 of seats are up for grabs, the president's party has lost seats 67% of the time, with an average loss of 3 seats. More recently, losses have been more extreme, with President Obama losing 63 seats and President Biden losing 41. Now, the only president to add seats in recent times is George W. Bush, riding a wave of support after 9/11 when the Republicans added 8 seats. The year after midterm elections, this is interesting, have historically been quite strong for stocks. Incredibly, the S&P 500 has been higher a year after every midterm election since 1950. So 18 out of 18 years, we've had a positive stock market following in the year following the midterm elections of 2023. So as we reflect back on this presentation and this research, we can understand that markets really hate uncertainty. And we know that midterm elections can bring with them a good deal of uncertainty. And what could it mean if history repeats, and now this time the Republicans take over both the House and the Senate this coming November? Well, one of the best scenarios under a Democratic president is Republican control of Congress, with the S&P 500 up an average of 16.3% during those years, while it's pretty hard for investors to ignore. What if the Democrats hold on to the Senate but lose the House? This is the second most likely scenario. That combination has also been quite strong for stocks, and historically, with the S&P 500 gaining 13.6% on average during those years. So I think the walkaway from that is that for whatever reason, consumers and voters and investors and Americans seem to like a split between the three segments of the federal government, between the executive branch and Congress, including the Republicans and the Democrats in the House and Senate. So that'll be very interesting to see what plays out this year and what that means going forward. So that's the end of the show, slideshow that I have. I will be uploading this to my YouTube channel. And if you want to watch a replay of this presentation, you can go to my website at bsikorski.com. Go over here to my YouTube icon, click on it. And then this will take you to my YouTube channel. And if you click on videos, this will show all the different presentations that all the other webinars I've given that I've recorded and uploaded to this YouTube channel. So with that, I'll say thank you very much for joining me. My name is Briant Sikorski, independent financial planner and wealth advisor with Stratos Wealth Partners. If I can be of any help to you in your important money decisions, please contact me at 919-650-1527 or Briant.Sikorski@LPL.com. With that, I will say thank you very much, and I hope you have a great rest of your day.